Will the 2026 plan actually work? That is the question leadership needs a financial model to answer. My name is Mahmoud Farag. In this project, I'm walking through an integrated FP&A budgeting and forecasting model built for a management consulting corporation. What makes this model interesting is its structure. Instead of starting with inputs and calculations, the model works in reverse. Beginning with the outputs, management needs to evaluate those outputs, define the dashboard. Once the dashboard is defined, the financial statements are structured to support it. The schedules then support the financial statements, and the inputs ultimately drive the schedules. So the model is effectively built backwards from the decisions management needs to make down to the operational inputs that drive those decisions. For example, how does the 2026 forecast compare to the 2025 actuals? How is performance tracking against the original 2026 budget? And based on those projections, will the company remain within its line of credit capacity? In this walkthrough, I'll build the model step by step. As we move through each section, I'll show how the logic flows through the financial statements and ultimately into the management dashboard. Before we start building the schedules, let me briefly explain the structure I'll use to walk through the model. We'll begin with the revenue accrued schedule. For each schedule in the model, I'll follow the same short process. First, I will explain the objective of the schedule. Second, I will explain the design logic behind it. Third, I'll build the schedule and review the calculations directly in the model. We'll follow this same structure throughout the model. I'll briefly show the schedules so the structure is visible. We start with the revenue accrued schedule. This schedule determines how contract revenue is recognized over time, so the income statement reflects a meaningful measure of profitability. Looking at the design of the schedule, first, the headings define the timeline across monthly, quarterly, and annual periods. The switch below the headings allow us to track whether a period is actual or forecast. Second, the contract switches, they define the months over which revenue should be recognized. Third, once the contract period is defined, the revenue is allocated across those months. This allows the model to recognize revenue in the period the work is performed. Now we start building the schedule. First, we calculate the contract period. Next, we allocate the contract revenue across those months. Finally, we perform a quick diagonal check in the bottom right corner to confirm the schedule is actually behaving as expected. Those amounts flow directly into the income statement and provide a meaningful view of profitability. However, recognizing revenue does not tell us when the company actually collects the cash. To understand that, we need to analyze receivables, so the next schedule focuses on how the company converts revenue into cash collections. Together, these schedules allow us to evaluate the company from two perspectives. First, profitability through accrued revenue, and second, cash efficiency through the timing of collections. Now we move to the revenue receivables schedule. In the schedule above, revenue was accrued to measure profitability on the income statement. This schedule analyzes when that revenue is actually collected in cash. It evaluates the company's ability to convert revenue into cash from clients. There are two contract types. Cynic contracts follow a percentage completion structure where cash is collected almost in real time, with a 1 month delay. End contracts follow a completed contract structure where cash is collected after the contract is finished, also with a 1 month delay. Below this, right here, is a receivables corkscrew, which tracks movements in accounts receivable. The final line converts those movements into cash collections, which feed the cash flow statement. Now, I'll build this section first and then walk through the logic. We introduced a switching mechanism to toggle between cynic and end contracts. Zeros represent end, and ones represent cynic. These switches determine the timing of cash collections. And here, I built a formula that turns on a switch in the payment month and multiplies it by either the cumulative accrued revenue for end contracts or the prior month accrual for Cynic contracts to calculate the cash receipt. The receivables corkscrew below here converts receivable balances into cash collected from customers. Now, the accrued revenue schedule measures profitability by recognizing revenue when it's earned. The receivables schedule, on the other hand, shows when that revenue becomes cash. Together, they evaluate the company from two perspectives: profitability and cash flow. Now, the revenue section can be used as a decision-making tool. At the end of the forecast, right here, we see a receivable balance of about 6.5 million. If clients begin delaying payments, switching contracts from Cynic to End shows the impact on cash collections, like this. I'll revert now. Now we move to the employee scheduling. This schedule forecasts employees and their compensation costs. Using the working day assumptions, I'll convert annual salary into monthly salary using a ratio of days. And finally, I'll calculate the employee count and add an alarm. Next is employee totals. This schedule consolidates employee costs to show total compensation by role over time. I'm going to calculate benefits, bonus accrued, and finally total compensation by summing salary, benefits, and bonuses. Sorry. Nice. Now we move to the employee payables. This schedule determines when compensation is paid in cash. First, I'll add data validation for the payout month, and then an if statement that triggers the bonus payout when the months match. And finally, I'll build the payables corkscrew, completing the employee section. Next, we move to the contractor scheduling schedule. This schedule shows how contractor work days translate into contractor expenses. These expenses are accrued amounts that will flow directly to the income statement, allowing us to measure the company's profitability. Before building this schedule, let's briefly look ahead at the contractor cash flow section. In that section, we introduce a 1-month payment delay since contractors are paid 1 month after the work is completed. This schedule uses a corkscrew to track contractor payables over time, and the final line converts those movements into cash payments to contractors, which will feed directly into the cash flow statement. This allows us to evaluate the company's cash management, which is another important financial health check. Finally, these amounts are aggregated into COGS and SG&A, where they contribute to the company's total operating costs. Now, back to the first schedule. First, we calculate the possible workdays using the net workdays function. Next, we calculate the contractor expenses. And now we add an alert check. Now we move to the contractor payables schedule. These balances right here are based on work performed in the previous month, which falls before the timeline of this model. And that's why we needed to load them manually as indicated by the footnote below. Now I'm going to build the schedule. Finally, we move to the total costs. The key point here is that the amounts flown into COGS and total operating costs must be accrued amounts, not cash amounts. Since these figures feed into the income statement, they must reflect the period in which the work was performed. Using accrued amounts ensures that the income statement provides a meaningful measure of profitability. I'm going to build the schedule now. At this stage, these schedules establish the core operating logic of the model, linking contracts, capacity, and people costs. The remaining sections of the model will build on this foundation. This schedule outlines the company's planned capital expenditures and their impact on fixed assets and depreciation over time. There are two main reasons for building this schedule. First, we need to summarize depreciation, which will feed directly into the income statement. Second, we need to forecast capital expenditures. We need a CapEx summary because this is going to flow into the cash flow statement and allows us to capture the company's investing activity. And third, we need the PP&E summary because this is going to flow into the balance sheet. Now, one important note to make is this management consulting corporation is still developing its software product. So it's investing heavily in software developments through CapEx. And since the company has not yet reached commercial production where it would begin selling access to the software, depreciation has not started yet. Depreciation would begin once the software enters commercial use, which is expected to occur beyond the timeline of this model. At this point, this schedule gives us everything we need from a planning perspective. It provides a clear view of expected capital spending and a depreciation profile that feeds directly into the income statement and the cash flow statement. With these links in place, the impact of CAPEX decisions is now going to be consistently reflected across the financial statements. Next, we move to the debt schedule. This schedule outlines the company's debt structure and shows how borrowings, interest, and repayments flow through the financial statements over time. First, we need to link cash and connect the increase or decrease in cash. Next, we link the available cash lines from the cash flow statement. Now we move to the line of credit. One important note to make here around the balance used for the interest calculation, I used the beginning balance rather than the average of the beginning and ending balances. This avoids introducing an unnecessary circular reference in the model. Since this is a monthly model, using the beginning balance provides a clean and stable calculation. With this in place, debt-related cash flow and balances are now consistently reflected throughout the model. Now let's move to the equity schedule. This schedule tracks changes in equity and shows how owner contributions and distributions flow through the balance sheet over time. First, we build the common equity corkscrew. Sorry for that. Moving on to the tax schedule. This schedule calculates income taxes and reflects their impact on the income statement, while also tracking the company's tax position over time. First, total taxes. Next, we apply an XLOOKUP function to link the appropriate tax rates. Now, for the lookup value, I'm going to link it to the year, right above here. Now, one important note here, the headers are all linked to the first schedule in the model. So there is no really empty cells. It's just looking empty because of custom formatting. The custom formatting hides the outputs. That's basically what's going on here, and I'm going to expand more on this after I finish this schedule. All the headers in this model are all linked here. Okay? And there is no any cells that are empty. If you look at the formula bar, as you see it right, there is no actually any cells that empty. It's just custom formatting. Okay? Now we move to the income statement. This section mainly consists of links and basic formulas. The income statement shows how much the company earned and spent over a period. It recognizes revenue when it's earned and matches the related expenses to the same period. So profit reflects the real performance of the business. Now we add the formulas needed to populate the cash flow statement and the balance sheet. This statement, the cash flow statement, tracks how the company manages cash over time. It shows how operating, investing, and financing activities translate into changes in the company's cash position. At this point, cash movements are fully reflected in the model. Now we move to the balance sheet. With this step complete, both the balance sheet and the cash flow statement are now fully built. And as we can see, the balance sheet balance. Next, we move to the Totals tab. Here, we aggregate the model outputs into quarterly and fiscal year views. Now we finished aggregating the income statement, we go to the cash flow statement. Here, we reuse the formulas we already built and copy them into this schedule. Now we go to the balance sheet. We're going to populate the balance sheet, and we're going to use a lookup function to populate the relevant values. To save time, I've built the next few schedules offline, since they follow the same formula structure we demonstrated earlier. And these includes the revenue schedule, the personal scheduling, the personal expense and working capital expenditure, and debt schedule, and finally the equity schedule. Next, we move to the output section of the model. This is where the work from the Model tab and the aggregations from the Totals tab come together on the Graphs tab. Here we present the results through visual exhibits that allow the data to tell a clear story for the decision makers using the model. These dashboards focus on four key areas: revenue, ending cash balance, EBITDA margin, and net income margin. In the ending cash balance section, we calculate available cash by subtracting the line of credit balance from the total cash amount. The labels at the bottom are used for the legend in the charts above. This one. And now I'll just go through the remaining schedules in silence. Starting with the revenue. This dashboard brings together actuals, forecasts, and budget comparisons in a single view, allowing us to evaluate performance at the monthly level and then step back into quarterly and annual perspectives. On the cash side, the focus is on the ending cash balance. A positive balance indicates sufficient liquidity, while a negative balance signals that cash has been fully utilized and the line of credit is being drawn. On the profitability side, EBITDA and net income margins naturally fluctuate month to month. When these results are aggregated into quarterly and annual views, those movements smooth out and provide a clearer picture of how performance is tracking relative to the budget. Together, these views allow us to move beyond month to month noise and evaluate the company's overall financial health, liquidity position, and performance against plan. Now that the model is built, the role of FP&A shifts from building to communication. At this stage, the objective is not to walk through every detail. It is to answer the key questions leadership will ask before they ask them. Starting with revenue, quarter one shows a clear execution gap. Actual performance is around 750,000 per month versus a budget of 1.5 million, a gap of roughly 50%. This indicates either demand was overestimated or execution fell short. From quarter two to quarter three, performance normalizes. So the issue is not structural, it is specific to early year execution. The key question is what changed and whether that change is sustainable. In quarter four, performance weakness again. Despite a higher budget, actual revenue declines. This suggests pressure from demand, pricing, or capacity. Now, linking this to cash. Cash pressure begins in quarter one and continues through the year. Even when revenue stabilizes, cash keeps declining. This shows the issue is not profitability, it is working capital. The increase in cash in October is not operational. Revenue does not increase at the same time. This indicates a financing event and most likely a draw in the line of credit. From October to December, this is where the model breaks. Cash drops by roughly 5 million and falls below the credit limit. And all of that happening without operational support. And this is the primarily financial risk. Looking forward, the forecasted recovery in cash depends on non-operational assumptions. Revenue growth alone does not explain the improvement, so the plan relies on either working capital improvement or continued financing. At a decision level, three things matter. Execution risk in quarter one. Ongoing cash pressure despite stable revenue. Dependence on financing or working capital improvement. So the plan is operationally viable, but financially constrained. From a management perspective, the focus is confirming what changed after quarter one and whether it's repeatable. Actively managing receivables and payables to protect liquidity. Validating the cash recovery assumptions are actually realistic. So, the real final decision the model surfaces is whether we treat the line of credit as a planned instrument or a last resort. Because if it's planned, we build a recovery around it. But if it's a last resort, we need to fix collections before quarter four, or the cash position becomes unmanageable. This is where the model becomes a decision tool. It shows where performance breaks, what drives it, and where intervention is required. So at this point, the model is no longer reporting results. It is defining where intervention is required.